Well, today we're looking at the Coronation Equity Fund. The manager there, Carl Leinberger and Quinton Ivan. A formation date back in April 1996. And the fund size 4.86 billion rand. The objective, the SWIX, and the TR 1.27%. Let's just take a look firstly at returns that we have seen from this. Of course, it has been around for some time in the market.
Yeah, I mean, I think firstly, the reason why we're looking specifically at the Coronation Equity Fund, it's one of those funds that have been around for a very long period of time. Coronation, obviously, it was one of the first kind of what I call specialist managers that emerged out of kind of the big life companies switch into specialist managers. And I mean, again, in Collective Insight, Lois Tassin talks quite nicely about team and team environments and so on. And this is obviously that team environment that they've tried to create over time, and obviously part and parcel of those of the returns that they've been trying to create. Just have a look at the table on your screen and you'll see what the returns look like for Coronation Equity. There you can see it. 12-month return 20.8 versus 16.8, and you could just kind of cast your eye down and you could see fairly decent outperformance over time relative to the shareholder weighted index, which certainly isn't an easy thing to do over time, and especially not to that degree. Anything that's longer, obviously, than 12 months is per annum returns. So that means every year. And if I just fast forward and I show you what the rolling returns look like for this fund, the blue shaded area is the fund's relative return to the benchmark over time. In some cases, as that is evident over there, there's some underperformance, obviously, relative to the shareholder weighted index. But you can see how beautiful the profile actually looks for this fund over time. And then, obviously, the red line is the shareholder weighted index and the rolling returns for the shareholder weighted index.
Mm-hmm. So let's just take a look at some of the sectors that it has a bias towards right now. Basic materials, 26.1%. Consumer goods certainly standing out, 20.9%. And then consumer services, 10.5%. And then you go down the list and you've also got exposure across other sectors. Roland, what stands out? Because, of course, when you look at it from a, standing back, 94% of the fund in equities right now, of course.
Yeah, it's a dedicated equity fund, so it has to have a higher equity allocation. The current style in the fund is very much focused on these global South African companies, so the BTIs, the Sasols, the SAB Millers, the Naspers, and they certainly did very well with that kind of allocation because emerging markets have done very well, and the South African portion of our market that is globalized has done extremely well. So if that continues and emerging markets don't perform forever, they will ride that trend. But that's certainly contributed largely to their performance.
But the Rand would have helped them.
Exactly.
The Rand dollar.
Exactly. These funds have done well because they are globalized and not.
And interesting, that Louis Tassin also brought up the issue of how managers, in his article, how managers deal with underperformance. And that, of course, is an important story because, fund managers can fall by the wayside. They, of course, can be forced to fall by the wayside. So what are your thoughts on that?
Well, I think actually it's Dave Ford who really talks about how the real trick in asset management is how to deal with your losses, how to manage your losses. And I think that's exactly right. It's when to take your money off the table, when to just sort of suddenly become extremely humble. And I think that if you had to pick one Achilles heel of any asset manager, it's the arrogance that says, I'm onto a great thing, I'm going to stay here. And you end up staying too long in the game.
Because you wonder what they did over that 2007 period and the weighting that they had. I wonder if it's still a big cap story.
Well, generally you'll find that a value-focused fund will outperform in a crash because it is a low beta strategy. It's a defensive strategy all the time. So they can underperform when the market is really running hard, but they will certainly outperform when the market's crashing, by definition.
You see, I mean, the big issue that you've got at the moment in any of these kind of general equity funds is that you've got industrials that look actually quite expensive from a valuation perspective. You've got resources which are actually quite dirt cheap, but continue to get even cheaper, which is a value manager's worst nightmare because you're buying cheap and it's just getting cheaper and cheaper and cheaper all the time. And the more money you throw at it, but quite frankly, it just gets even cheaper, And then you've got financials that are kind of sitting kind of in the middle ground, but with potentially some storm clouds kind of ahead. So if you're running a general equity fund, how do you allocate money? Very, very difficult now, especially when you're a value manager.
Well, that's what one of the things that people are bringing up at the desk here is that the local world, domestic investors here are battling to find opportunity because all those stocks, the likes of BTI, the likes of SAB Miller, are all just so expensive. But if you look at the alternative, it's like, do you put your money down a sinking hole if you call some of those resource stocks that right now? I mean,
but value hasn't
question.
done well for the last 2 years. It's been a momentum and growth market without a doubt. So it's done very well for managers who haven't had a value focus. So they're smiling without having to sweat as much as the value managers have.
I think another dynamic that we're seeing is that those asset managers that have the luxury to have a global focus are also doing well. And those, because we're no longer an isolated game. We're part of a bigger picture. And if you can understand how the bigger game is being played, you can understand what our role is in that game. If you're only thinking of South Africa and you only see South Africa as expensive within our context, you're missing the fact that other managers from outside of South Africa will bid up these shares.